All right, welcome to video 1 of my Concepts and Confluences chapter. In this first episode, I will be talking about liquidity and the liquidity levels within the market. First, I'm going to talk about what liquidity is and why it matters. Then I'll move on to how the market moves based on liquidity. We'll go over order flow and engineered liquidity. We'll also talk about external and internal liquidity. And then we'll finish it off with liquidity levels like time-based liquidity, key opens, and more. But first, you're probably wondering, what is liquidity? And again, why does it matter? Within trading, liquidity can be described as resting orders in the market, and more specifically, orders that traders like us place. So every time a trader puts a stop loss above a high or below a low, that stop loss becomes liquidity. And it's the same thing for pending orders, like when you place a limit order to buy or sell, or a stop order to buy and sell, that would also become liquidity. It's really obvious and easy to spot this around obvious highs and lows within the market, especially on higher time frames, or even in consolidation zones or accumulation zones, as I've called them in the past. This is really important because liquidity is mandatory. It's like essential for price action. Liquidity is literally fuel for price movement. The market needs it in order to move up and down, kind of like momentum. So because of this, price will often go in the opposite direction first to hunt and target and sweep that liquidity before it moves in its actual intended direction. Think of it kind of like a trampoline. I just thought of this analogy. When you're standing still on a trampoline and you jump, you're pushing downwards with your legs with downwards force to propel yourself upwards and actually jump. But because a trampoline isn't solid ground, you can literally see the downward pressure that creates like a dip in the surface of the trampoline. Like you can literally see the trampoline moving downwards when you jump. And then the trampoline reacts to this force by propelling you upwards. So similar to the market, like you have to go down first to come back up. Within the market though, we call this manipulation because this can manipulate a lot of traders into thinking the market is actually going in one direction, like maybe going up, when in reality, it's actually just looking for buy-side liquidity up there to propel price in the opposite direction and go short. So this is really important, and I can actually find some examples right now, especially like I said, if you look on the higher time frames, it's really, really easy to spot all these things. You can kind of just see how the market just moves up, down, up, down, up, down. And every time it does that, it's most likely because it's reacting to a level of liquidity at one of these points, which in turn forces it to go back in the opposite direction. And you can literally see that over here with all these different spikes, these wicks that come up and down. Some moves are obviously longer than others. So that might mean, hey, this area, because it made this huge downward move, is an area of strong liquidity. Okay. So that's a very basic introduction to liquidity. I'm going to move on to chapter 2 and also just talk about some of the other factors of liquidity and again why the market moves in the way it does, how you can spot liquidity, order flow and stuff like that. So all these really important concepts and topics that you really need to learn and master in order to start understanding the way the market moves so you can see it in real time and react to it. All right, so now that we have a basic understanding of what liquidity is, we can really look into why the market moves the way it does. And we can really see the impact of liquidity and how it really pushes price in certain directions. So at all times, whenever you're entering a trade, whenever you're analyzing the market, you should always be asking yourself, what is the market doing? And every single time you should be able to answer with one of these things. 1, the market is either hunting liquidity. 2, it's looking to rebalance inefficiencies within the market, like fair value gaps. 3, it could be rebalancing to equilibrium of the price range. And 4, it could be generating liquidity. So real quick, let's just go over all 4 of these. So let's draw some bullshit lines over here. All right, so first for hunting liquidity. As you can see here, remember I mentioned that during consolidation zones, that can be seen as high probability liquidity. Let's draw a line right around here. And let's make this liquidity. Oh, let's actually do a better line for liquidity. All right, that's better. All right, so in this consolidation zone at the top over here, let's consider this to be liquidity. Now, whenever we're in a trend, these highs and lows will also be liquidity. So let's draw these out as well. So we consolidated, we came back down. On the way down, we created more highs and lows. These highs, if we were to come back to the upside, could be seen as liquidity that we're going to hunt. And ultimately, we're always going to try to hunt the highest or lowest point of liquidity. So in this example, the highest liquidity, this would be our external liquidity, is most likely going to get hunted at some point. So it doesn't matter if price, maybe retraces back down after this or does some patterns. At the end of the day, it's going to reach back to this point of liquidity because it needs to. So this is why we say hunting liquidity, because it's going to head towards a certain drawn liquidity, a certain area where there's a lot of orders or a lot of liquidity in the market, and it's going to actively hunt it out to sweep it before it can maybe come back in the opposite direction and come back down. Okay, this is obviously a very random example, but hopefully that helps. And also, let's get rid of some of these lines. We've talked about this many, many times before on the channel. When we're displacing, when we're creating these highs and lows, and when we're in a bearish or bullish trend, we're going to be creating fair value gaps on the way up or down. So this could be a fair value gap. Uncooked. Okay. This could be a fair value gap. And again, this is just obviously random examples. And then we obviously, with these fair value gaps, we came back to retest them in my example. Right here, we came back and mitigated this price action within this fair value gap, and we come back down. However, on the way up, when we're hunting our liquidity, let's say we form a fair value gap right here. There's a very, very, very slim chance that we just continue all the way up to hunt this liquidity before or without tapping into this fair value gap. Because fair value gaps are inefficiencies within the market. They're literally gaps within the market where there's not much price action. So price is generally always going to come back to rebalance these inefficiencies, to fill these gaps before it moves back up in the right direction. Boom. And this could maybe even be another fair value gap that we retrace into. So that's why you're always going to see retracements. And most of the time, if you look at these retracements, there's going to be a fair value gap that price taps into before it goes back up in the intended direction. So this is rebalancing inefficiencies. And that's why also in my model where I'm looking for draws and liquidities, I'm targeting unbalanced or unfilled fair value gaps, because price is going to draw towards them. It has to rebalance them. It has to fill them in before it can actually move in its intended direction. So being able to catch trades either coming out of those or going into them is really good, because again, those are very strong draws in liquidity, as it's one of the 4 things that the market is always going to be doing. Now for rebalancing equilibrium, obviously if you know the definition of equilibrium, you know, I kind of can guess where this is going. But say for example, let's maybe look at this leg in price right here, this entire leg where we're coming back up to this external buy side liquidity. We're coming back up after, going super low. We're going to start the move to come back up to the upside. Let's look at this leg specifically. And let's also drag this point. Oh, whoops. Oh, can I not do that? Oh, I can. Okay. Let's do this. All right. So on this leg up, like I said, we're going to come back down to rebalance inefficiencies. And most times when you're rebalancing inefficiencies, you're also rebalancing maybe to equilibrium. And what equilibrium is, it's just the 50% zone of any range. So let's take our Fibonacci tool. Let's draw maybe from this low to the high of this range and drag it out. I think I have an equilibrium. I do. Perfect. So I recommend that all of you guys make a template with your Fibonacci range like this, with just 0, 1, and 0.5 enabled or checked off, whatever. That's going to make you a little rectangle that has 1, 0, and 0.5, the midway point of this range. This midway point is going to be called equilibrium because it is the exact middle of your range. Equilibrium is a very, very, very important part of price action because when we're retracing, most times we're going to have to rebalance to at least a premium or discount of this zone. And I'm going to get into premium and discount in a later video. I already have like the plan for this series laid out, so I definitely going to make a video on equilibrium and premium discount zones. But to get into it really, really quickly, you have premium zones, which is within the top half of this equilibrium range, and you have discount zones, and vice versa if you're obviously going in the opposite direction. But when you're coming up on a move and you mark out your equilibrium, like I said, say we're going long, so we're going up with price action. The higher we get, we are in more of a premium of price. So it wouldn't make sense to buy while the price is super high. Ideally, you want to wait for a retracement for price to come back down lower, maybe into this 50% zone or into this, again, discount zone where price is cheaper, so you can catch it on the way up. It leads to more probable trades. It leads to, just a lot more profit when you actually wait, because there's going to be retracements. Like there's always going to be retracements. So being able to wait for a price to come back to equilibrium at least, and maybe go into a discount zone before it goes back up, is always going to be important. So this kind of ties into rebalancing inefficiencies, number 2, because say we have a fair value gap right over here, and prices come all the way up here, we're going to come back down to not only refill this inefficiency, but also to rebalance equilibrium and come back down to, again, this discount zone. So when you look at all these legs, a lot of times, and I just drew this very, very randomly, but a lot of times when you look at price action and when you actually look at it with maybe an equilibrium tool or an equilibrium drawing, you're going to see that a lot of the retracements and the rebalancing of the market comes back down to at least like a 50% level or at least around there before price moves back in the opposite direction. So definitely recommend you guys draw out an equilibrium tool. It's very helpful to look at the market and understand retracements, understand discount and premium zones, because again, you shouldn't be buying and looking to go long when price is all the way up here, because there's going to be retracements and you might get stopped out before it actually goes in the right direction. Ideally, you would want to have your entry down here, at least at equilibrium of this range. And once you get confirmation that price is going to go into the intended direction, boom, it's a lot easier to take your trade because you have a lot less drawdown and you're less likely to get stopped out. You also just have a better fill coming from here versus up here. You can target a lot more points to the upside. And then last but not least, price is generating liquidity. So what do I mean by that? This is basic order flow. This is basic engineered liquidity. And I'm also going to talk about that in like one of my next points, like literally like right after this. So I'm not going to go too much in depth right now because we're literally going to talk about it in a few minutes. But ideally the market is generating and engineering liquidity whenever we make these highs and lows. Okay. I'll draw this a little bit better in a few seconds, but say for example, this high we create when we come back to maybe rebalance equilibrium, rebalance inefficiencies, we're generating liquidity. This low, we're generating liquidity. This one, all of these little highs and lows are generated liquidity on the way either up or down. So like I said, we're coming down. We're making this point of sell side liquidity. We're going to come back up to rebalance maybe equilibrium or rebalance an unfilled gap or an inefficiency. Boom, we make that high. That's, again, engineered liquidity. We come back down to make a lower low. That's more generated or engineered liquidity. We're going to come back up, rebalance equilibrium, rebalance inefficiencies. Boom, that's more engineered liquidity. And these engineered liquidity points are points that you can target when you're trading in the opposite direction. Because again, price is always going to want to hunt out this liquidity. Oops. So you can always target these. You can always expect these points of liquidity to get taken out, to get targeted. And say, for example, you just want to catch like a small safe trade, like maybe right over here, you see prices starting to reverse. Boom, you can target this engineered liquidity because you at least know that price is going to hunt it out. It's going to look to sweep it. And boom, you can have your take profit right below this high. That's a very safe stop loss or take profit placement at points of liquidity because, again, you know that price is going to hunt it out, to sweep it out. And again, just target it. So like I said, for generated and engineered liquidity, I'm going to get into that right now a little bit more with a talk on order flow. So let's get into that. Within order flow, we obviously have two directions that price can go, up and down. Up is going to be called bullish order flow. Down is going to be bearish order flow. In bullish order flow, we are making higher highs and higher lows. Very obvious. Like a 5-year-old can obviously determine that we're going up and that we're trending upwards in this example. This is bullish order flow. We're going to be making higher highs and higher lows on the way up. And all of these retracements are, again, maybe rebalancing inefficiencies, maybe rebalancing equilibrium of the price range, whatever it is. But there's going to be higher highs and higher lows. And obviously, in the opposite direction, with bearish order flow, we're going to make lower lows and lower highs. Super simple. Super basic, guys. Okay. So within this example of bullish order flow, as we're making these higher highs and higher lows, again, what are we doing? We're engineering liquidity at all of these lows. So let's draw this out. We're coming up. Let me actually draw this a little longer. We're making all of these lows, these points of liquidity that, again, the market is going to want to hunt out. Maybe I shouldn't have done so many, but all right, almost done. So obviously with these highs, in bullish order flow, we're going to take out all these highs as we come higher to make higher highs. So when we talk about engineered liquidity within order flow, the engineered liquidity is generally on the opposite spectrum of whatever direction we're trending. So we're trending upwards, we're trending bullish. Our engineered liquidity is going to be the sell side liquidity that's made with all these retracements on the bottom. And as you can see, within bullish order flow, whenever we make these points of liquidity, they're not getting swept out because we're still trending upwards. So that means we have all of this liquidity on the bottom that is unfilled, that's unswept, and that's going to be a high probability draw on liquidity. So once the order flow changes from bullish to bearish, we might maybe do this and then come back up for a manipulation leg and then start coming back down to target these, points of liquidity. And as you can see, price is going to sweep out all these points of engineered liquidity, maybe retrace, maybe react to that level of liquidity in some way, shape, or form by maybe retracing or, like I said, filling imbalances, whatever, before again continuing to hunt out more liquidity, continuing to sweep out liquidity. So it's always really important to look at engineered liquidity in the market because you can see draws in liquidity, areas where price might be likely to go, areas where there's just tons of unfilled orders maybe. And obviously you can't really see orders unless you are using like an order flow tool or footprints or whatever they're called, heat maps, whatever. I don't even remember what they're called. But obviously if you're just looking at the charts like this, like you're not gonna be able to see the actual orders, but you can see like we have maybe some equal levels over here. We have some of these highs right over here. We have a high right here. And what happens every single time? Almost every single time, these points get swept out. Boom. Boom. This actually might be, I don't think these get swept out because this is all-time highs. So they haven't gotten swept yet, at least on my chart. Yeah. And then obviously because we are engineering all this liquidity, we have these points that, haven't gotten swept yet. So ideally, once we start bearish order flow, we're going to be looking for some of these points to get taken out, these lows within the market, because this is all liquidity. Okay. So again, if we start some bearish order flow and we get more confirmation that we're trending downwards, what can we expect? The market to come down, sweep out some of these liquidity, retrace, sweep out the next one, retrace, sweep out the next one, etc. I don't really like to look for generated liquidity on the 1 minute time frame, unless like I'm placing where my profit target is going to be or where my stop loss might be. I generally like to look at liquidity points on higher time frames because those are a lot cleaner and they don't have as much manipulation as the 1 minute time frame might have. But you can see this on literally any time frame. Like maybe let's delete. Oh, well, I don't want to delete actually all my writing. Actually, no, I'm done with this. Yeah, so let's delete everything. It's a lot easier to see these on the higher time frames. Like let's maybe go to the 15-minute time frame. And you can see we have all these high points that just get swept. And almost at every single high, we react to it a little. As you can see, like we finally sweep this high. We react to it a little by coming down, starting some retracements, some rebalancing of inefficiencies, whatever, before going back up. Okay. And let's look at this one maybe. This is also a good point of liquidity. This one, we sweep it, we barely sweep it, we come back down, we accumulate around this area. That means there's probably a lot of orders in this area because we swept it, we stayed within this area for a very long time. And what did we do? We just accumulated within this area of liquidity. We're just consolidating, we're accumulating, all this right here. And then we continue to accumulate. We manipulate downwards with this area. And I'm willing to bet you that there's at least probably a fair value gap somewhere in this range on maybe one of the higher time frames. We manipulate downwards. And then price again goes in the intended direction, which is upwards to all-time highs. Distribution cooked. Okay, so this price is just accumulating. It's hunting liquidity. It's looking for more orders to be filled within this area. Oops. Within this area, because again, this is probably just an area with a ton of orders to be filled. We're accumulating within this zone. We're going to come downwards to sweep all of this liquidity from this consolidation zone. And again, maybe tap into a gap on higher time frames. And then we come back up in the actual intended direction. So again, with the trampoline analogy, think of this as you're standing on the trampoline, you're not going anywhere. This could be maybe where you start pushing downwards with your legs to create force. And then the trampoline comes down, it pushes you back up, and you actually go in the intended direction. So obviously, as you can see, these points of liquidity, and this must have been a strong point of liquidity because it started a huge move. Like price needed to come down here first before it could go back up to sweep out all of this liquidity from this accumulation zone and also just create all-time highs. And again, it's a lot easier to see that on the higher time frames because there's just a lot less noise, a lot less manipulation, but it becomes really obvious to see, especially when you can see like these super long wicks like this. Oh, perfect example. What do we have right over here? An unfilled gap. Damn near an unfilled gap. Like we might have wicked into it. We tapped into it right here, barely. We barely tapped into it. We came back up for a huge move. And then let's say right here, you're thinking we're in bullish order flow. Boom, let's say you want to go long right here. You're like, oh, we're going to target maybe this high. All the way up here. What happens? You get stopped out. And you know why? Because there's an unfilled imbalance right over here that price has to tap into before it can go back up. And what does it do right when it goes back up? Right when we tap into this imbalance, right when we refill this inefficiency, boom, we skyrocket back up from 23,844. Let's actually use a ruler. All the way back up here for 200 points to sweep out this next point of liquidity. Okay, so when you have a draw on liquidity, like maybe you're seeing us trend upwards, you're thinking, oh, we might actually sweep out this high. you want to make sure that there's no unfilled imbalances, maybe down here or at least in this range, because price is always going to come back down to rebalance them first before it goes in its intended direction. So this is clear textbook manipulation. It even formed a rejection block. Like, this is crazy because we wicked all the way down here, and then this is also on the 15-minute time frame. So on the 15-minute time frame, we came back down 80 points and came back up to close right here, all within minutes. Like, that's ridiculous. That's clear manipulation. Like, price literally just had to go there before it could come back up. So again, it's really easy to spot those with these long wicks, with unfilled imbalances, with highs and lows within the market. And there's actually an indicator that I used to use a lot. This one, higher high, lower low, live by Lonesome the Ranger, I think it is. And it literally just shows you order flow. Like, it can tell you lower highs and lower lows. So it's a lot easier to see, you know, which way we're trending. We're making a high, a higher low, higher high, higher low, higher high, and we make a new low because we swept this out. So this actually might have started bearish order flow because we made a low instead of a higher low. And now we're making lower highs, higher lows. Well, this wouldn't really count with bearish order flow, but another lower high. So obviously I don't know what's going to happen next week, but say for example, we have all this engineered liquidity on here because we're in an uptrend and all of our lows are going to be engineered liquidity. We have these. Say for example, after maybe making this low, we start some bearish order flow. We come up here, boom, boom. We might take out this point of liquidity, come back up to rebalance maybe to equilibrium of this range, of this move, maybe rebalance an inefficiency on the way, come back down, sweep some more liquidity, rebalance, come back down, sweep this generated liquidity, rebalance, and then maybe start some more bearish order flow and just rebalance all this shit. Maybe even these points, maybe even these points down here. This is all engineered liquidity. And once order flow changes, it's going to look to hunt and target the unfilled imbalances that are down there and the points of liquidity that have been generated. All right, now moving on to internal and external liquidity. The best answer I have for you guys on this one is going to be dependent on your time frames, okay? So for me, I look at external liquidity as higher time frame swing highs and swing lows. And the internal liquidity would be all of those little points on maybe the slower time frames, the middle time frames that propel us to those points of external liquidity. So right now I'm on the 15-minute time frame. I consider this to be a middle time frame for me because I like to use, especially within time frame alignment, the 4-hour aligns with the 15 and the 15 aligns with the 1. Okay, so obviously we have two opposite ends of the spectrum, 4 hours and 1 minute, and then right in the middle is 15-minute. So for external liquidity, I'm generally on the 4-hour time frame looking for swing highs and swing lows. And as you can see, it's really, really obvious to see those. Swing low, swing high, swing low. We come back up for this one, make another low. Oh, well, actually what we did was this. Okay, so obviously we have these swing highs and these swing lows. These points are going to be our external liquidity because they're liquidity from the higher time frames. So let's say we want to zoom into maybe this range. Let's look at this range right here, from this swing low to this swing high. And let's actually mark this out. This low and this high, these two right here. Let's look at this range specifically on the, let's do a 15-minute time frame. Okay. So obviously on the 4-hour time frame, let me go back to that real quick. On the 4-hour time frame, it's not easy to see swing highs and swing lows over here because we get to see this one move going up. But if we look at the 15-minute time frame and we again go to our range, what do we see? We see more swing highs and swing lows on the 15-minute time frame. So you can see maybe prices come back up, come back down, up, down, accumulating a little, but still making some swing points. Up, down, and then back up. All this is internal liquidity because these are points made on the lower time frames where there are swing highs and swing lows. And say we were to go to the 1-minute time frame, if we can find it. We can. On the 1 minute time frame, you can see even more swing highs and swing lows that I didn't even mark out on the 15-minute time frame because they weren't there. All these little swing, like we didn't even see this move. Boom, this right here. We didn't see this. We didn't see maybe this swing low. We didn't see this swing high. We didn't see some of these points of engineered liquidity, these swing lows over here. What else? There's a lot more noise on the lower time frames, and that's why it's internal liquidity, because it's not as important. Ultimately, we're going to head towards draws in the higher time frames, and on the lower time frames, there's going to be a lot more movement because these moves are a lot smaller. The candles are a lot smaller. It's a 1 minute candle versus a 4-hour candle, obviously. So we're going to see a lot more swing highs, a lot more swing lows, a lot more movement in like on the way to the intended draw on liquidity and on the way to, you know, the direction that we're going in. So internal liquidity, again, it's best to be described as lower time frame swing highs and swing lows. And external liquidity will be higher time frame swing highs and swing lows. And when you use time frame analysis and alignment to pair those together, it's really easy to see swing highs and swing lows that actually align and make sense with each other. And like I said, for me, I personally like to use this one. So weekly aligns with the 4-hour. The 4-hour aligns with the 15-minute. And the 15-minute aligns with the 1 minute. You can also do the monthly with the daily. And the daily with the hourly. And the hourly with the 5-minute. Okay. So obviously the weekly and the 4-hour will be points of external liquidity within this type of time frame alignment. And the 15 and 1 minute will be our internal liquidity. And on this time frame alignment, the monthly and daily would be your external liquidity, and the hourly and 5-minute would be your internal liquidity points. So again, swing highs and swing lows within lower and higher time frame, charts. So super easy. All right, so not all liquidity is created equally. There are some points of liquidity, some levels that are more probable and more important than others. And I've already written out a few for you guys. So let's go over all of them in depth. So we have session highs and lows. Obviously, if you trade, you know that there are different sessions throughout the time of day. There's Asia session, there's London session, and there is New York session. I primarily trade New York session, which is 9:30 to I think 4. But there's also Asia session, which is at night. It's an EST, which is Eastern Standard Time, my time zone. That's 8 to I think 4. And primarily we would look for like 8 to 12 within Asia session, or sometimes 9 to 12. It really depends and varies from trader to trader, but I like 8 to 12. Then you have London session, which is, I believe, 2 to 12:30 EST again. And I generally do 2 to 5. So 2 a.m. to 5 a.m. for my London kill zone. And then obviously all of New York session. But session highs and lows are going to be really important. Let's take a look. So let's turn on our kill zones and pivots indicator. Again, this is an indicator that I use to not only draw out my sessions, but also mark out their highs and their lows. And also it shows me the previous day low, the previous day high, the daily open, the 8:30 open, the midnight open. And I'll show you guys how to have all this drawn out for you, so you don't have to like physically go and mark these levels out, draw them yourselves. It'll just pop up for you with this indicator. So as you can see, let's look at maybe this day. We have Asia session, London session, and New York AM. These points of liquidity, the highs and the lows from each session, are going to be really probable draws on liquidity. Let's actually look on the 5-minute time frame, just so there's a lot less noise. Boom. As you can see, we create these highs, and this high for the entire session, this low for the entire session. These are strong draws on liquidity. So as you can see, we make our range, and we come back down almost exactly to that draw on liquidity. We didn't sweep it though. So this could maybe be an example where ES, the S&P 500, maybe swept this range, and then its price just started reversing, because if it swept it on the ES, on the S&P 500, Nasdaq doesn't always have to. So you always want to have both of your charts pulled up right there. So first and foremost, that's very important. But again, this is a strong draw on liquidity. We started heading in this direction and we came within literally 1 point of it. So boom. We make our London low and our London high. And what happens? In New York, we literally sweep out all of these points of liquidity. We sweep out London highs, we sweep out London lows and the Asia lows, and then we move in our intended direction. So you always want to look at the Asia and London session highs and lows while you're coming into New York pre-market, because we're going to look to take out some of those highs and lows. We're going to react to them. As you can see, like here, we looked into it and we reacted very, very strongly in the opposite direction, and we started going towards all-time highs. So again, these time-based liquidity points, these session liquidity points are very, very important. All right, so let's delete these. Actually, let's keep that because I don't want to delete the writing that I had somewhere over here. Okay, so that's session highs and lows. Let's also get into daily and weekly levels. So again, these would count as strong points of, at least for the daily. Oops. At least for the daily and weekly levels, again, those are points of external liquidity. And if you remember what I was just saying about time frame alignment, the daily aligns with the 1 hour and the 5 minute, and the weekly aligns with the 4 hour and the 15, and the 1 minute, obviously. So by looking at the daily time frame and looking at these highs and lows, it's very easy to see that price is, going to sweep out some of these forms of external liquidity, because these are like very, very, very external points of liquidity. Okay, and that's why they're so important, because these are like some of the most external points of liquidity within, swing trading, within day trading itself. You're going to target these highs and lows of these days, of these weeks, very, very often, and they're very strong draws in liquidity. So I don't have to get into that too much. That's pretty self-explanatory. Data highs and data lows. If you guys can recall, actually this is a perfect example because this week we had a lot of data. Let's go to 8:30. So this week was CPI week. Oh, maybe not on Friday. I think it was Tuesday. Yes, it was. We had PPI on Tuesday and CPI on Wednesday, I believe. All right, so news that comes out at 8:30. Well, news can come out at any time, obviously, but a lot of times news is going to come out at 8:30 if it's things like CPI, things like PPI. Oh, I'm sorry, I had it mixed up. PPI was on Wednesday and CPI was on Thursday. But these generally come out at 8:30 a.m. And every single time news prints, you can almost instantly see the impact on the charts. So let's look at Thursday, September 11th at 8:30 a.m. where there was CPI. And again, I'm on the website Forex Factory. This shows you economic news and financial news that would impact the markets and every single currency. I primarily look at the USD impact and red folder news because that's the most important. So CPI is the core price index, I think. Yes, consumer price index, sorry. And if we hop on the charts, we'll be able to instantly see the effect that it had. So at 8:30, when this candle prints, we ranged for 128 points within the span of 60 seconds. Like, outside of news, that's like unheard of, okay? These highs and lows that are created by these data candles are very, very strong draws in liquidity. And let's actually draw them out so we can see. So we have our data high, and let's draw our data low, okay? So almost instantly, our data high gets taken, and we can actually probably count, because this happened at 8:31. So we can probably still count this as like the high from data, to be honest. We come back down to rebalance a lot of this area, maybe rebalance to equilibrium of this area, at least a premium or discount zone of this area. And then we come back up to target these data highs. So as you can see, when we come down after the news candle prints, we rebalance, boom. We're coming back up. You can see that we're trending upwards. Maybe the draw is going to be the data highs. And what happens at the data highs? We react to this level very strongly. We come back down, rebalance equilibrium, and we just start to maybe consolidate a little around this range and just chill around this range. And as you can see, we tap back into this point of liquidity, this line, the data high, multiple times. Like we wick into it here, we wick into it here, we wick into it here, we wick into it here and react very, very strongly actually. These data highs and data lows are very strong points of liquidity. They act like kind of like magnets, to be honest. And this data low, honestly, I don't think it ever got filled. So that could be a potential draw on liquidity maybe in the future, but I doubt it, honestly, because we've trended so hard like in the opposite direction that I really doubt we're going to come back to maybe this one point of data lows. But ideally, whenever there's CPI or PPI, whatever, whenever there's news, I'm generally looking for either a high or a low to get swept out during New York session pretty instantaneously, pretty instantly. So that's exactly what happened. We swept this out like right when market opened. We reacted to it and boom, opposite direction. And then we just ranged and continued to geek for the rest of the day. Now next, structural liquidity. This can be equal lows and equal highs in the market. Oh, literally a perfect example right here on the daily time frame. What do we have over here? Equal, oh my God, we have 3 at this point, just about. So as you can see right over here, we have a line that we can draw where price taps it almost at the same exact point, like maybe like 1 or 2 points off, multiple times. These are equal highs and equal lows. Whenever there's points right here, like whenever price is reacting and rejecting this level, like, and we just got to all-time highs. I really am expecting next week to be very bearish because we're going to probably rebalance a lot of these things and boom, sweep out some of these equal lows. Maybe not, if not next week, then the week after, but we have a lot of equal lows down here, a lot of engineered liquidity on the way up that needs to get swept. And these are going to be very strong draws in liquidity. So again, by structural lows, I mean, you know, equal highs, equal lows in the market, points where price is reacting and rejecting very, very strongly, like this. Let me delete that so you guys can see it better. Like that's very, very obvious. Let's huge liquidity zone right here. We also have consolidation ranges. It's a lot harder to see consolidation ranges on the maybe the daily time frame. So let's go down to like the 5 minute or something. Oh, nice. Consolidation range that literally got swept right over here. So we're consolidating within this range. This is all consolidation for the span of from 5:35 a.m. to 7:20. So just about 2 hours. We're consolidating within this range. And what do we do during New York session? We come out and we sweep this consolidation. We manipulate downwards to sweep this consolidation range, take out a lot of the orders, maybe fill a lot of orders in this area where price is just building up, it's accumulating in this area. We manipulate below that and we head in the opposite direction and catapult to our intended direction. So consolidation ranges on sometimes the mid time frames, like the 5 minute, the 15, maybe even the 1 hour sometimes, can be very, very strong draws in liquidity, like the bottom and high of these areas. Next, within structural liquidity, we also have swing highs and swing lows in obvious places. I've already talked about this many, many times. You know, your internal and your external liquidity, those are going to be very strong draws in liquidity. Okay, so that's very straightforward, very easy. All right, and then next, sorry, I deleted it by accident. We have time-based liquidity. All right, so time-based liquidity can be seen as all these things that I have marked out right here. PDH stands for previous day high, and obviously vice versa. PDL is previous day low. We have our 8:30 a.m. open, which is when New York pre-market opens, and also that's most times when news is going to drop. We have our daily open, our midnight open, and then, you know, our session highs and lows. Again, those obviously count as session highs and lows, but that's also time-based liquidity, okay? So I use this indicator right here called ICT kill zones and pivots. So let's click on the settings for this indicator, and we can look at my settings. So again, Asia, I have 8 to 2. London is 2 to 5. New York, lunch PM, all that bullshit. And then let's go to my key levels. So I have these open. I have midnight open and 8:30. I also have it showing the daily open, the high and low, and where's the previous day? I thought I had it. I don't know where it is, but it clearly shows PDH and PDL. So I just don't know where the setting is for that. But all these things are very, very important. So let's look at some examples where, we maybe react to the midnight open. Oh, this is actually pretty perfect. So we have our midnight open. So this is our midnight open. Let's take a look at this level right here. I'm gonna draw a horizontal line at the midnight open. All right, midnight is obviously right around here. All right. Let's actually just delete this now that I have the lines. So midnight, this is the midnight candle, okay? And the midnight open is right, let me move this down, right here. Right where this up close candle opens, that is our midnight open. And let's just look at how price reacts to it, okay? So we're coming back up during London session, and boom, we come back down, we tap this midnight open perfectly. We react to it, we bounce off of it. We come back down, we react to it, we bounce off of it. We come back down, we displace below it. So we're finally starting maybe a trend in the opposite direction. And we come back up, we react to it, bounce off of it. Come back up, we react to it, we accumulate around this area. We wick towards it a couple times. Like, this is just a huge accumulation and liquidity zone, because there's probably a lot of orders right around here at the daily open. That's the true day open, midnight open. Again, even over here, so I had marked this out as the consolidation range on like the 5-minute time frame, I think, that we swept out during New York. I also didn't realize we tapped right into this midnight open. Like, this is a very strong level for price to react to bounce off of, to react off of. And what do? Catapult from there during New York session, where there's a lot more volatility and liquidity in the market. That's just one example of the midnight open. But if you go back on the charts, if you backtest, if you look at maybe the 8:30 a.m. open, the midnight open, the daily open, which is at 6 p.m. So the opening price at 6 p.m. every single day, you will see these are like magnets for price. Okay, price is going to react to it. It's going to bounce off of it. It's going to draw towards it multiple times. Again, it's like a magnet. It's crazy. Time-based liquidity is very, very important. And obviously all of the ones that I just drew out and wrote for you guys are very important. I just ended up deleting it, but you have your session highs and lows, your daily levels, your weekly and monthly levels, your data levels, like the highs and lows from news events. You have structural liquidity, which is equal highs, equal lows, consolidation ranges, swing highs and swing lows. And you have your time-based liquidity. That can be key opens, that can be session opens, session highs and session lows. So yeah, very, very strong points of liquidity, and things that you will notice more and more as you begin to study the market, start to understand it, as you backtest, as you analyze things. And obviously it's very easy to overcomplicate things and just get analysis paralysis when you're looking at all these different levels, all these different points of liquidity. But again, I use these as more of like an indicator. Okay, I'm just looking at these to see where these levels are, to see points where we might react and bounce off. I'm never just blindly taking a trade based on, oh, I'm going to set like a limit order at the midnight open. Like, I'm never going to do that, obviously. What I'm doing is waiting for confirmation for my trades. And these points are not confirmation. These are just indicators, maybe confluences, that you would align with confirmation to take your trade. Okay, never like blindly enter your trades based on these liquidity levels or time-based liquidity. You're gonna blow your accounts. You're gonna get fucked. You're gonna get cooked in the markets. That's never gonna be okay. You want to use these in addition to other confluences, in addition to other concepts, and again, use these to make the best analysis and decision possible. And then you enter your trade when you have confirmation. All right, so that was just a very brief rundown on liquidity, why the market moves the way it does, liquidity zones, liquidity areas, things that, like maybe even order flow, engineer liquidity, external and internal liquidity. So definitely, like I said, take note of all these. Make sure you guys look back through the markets, really just understand how price is moving, why it's moving. And once you start looking at the market with the lens of like liquidity, everything changes, okay? Everything, like I probably remember the day that I remembered and like learned about liquidity. Like literally everything started to click. Everything started to make sense now, because I was like, oh, like it makes sense for us to head in this direction. it makes sense for us to head towards this gap. It makes sense for us to rebalance this, or it makes sense for us to maybe manipulate to this level. It makes sense for us to go this way instead of that way. Like once you start thinking in terms of liquidity, in terms of orders in the market, in terms of, points where price is likely to go, everything starts to make sense. And you just become a more well-rounded trader. And that's always the goal. The goal is to become the best trader possible. Okay? So keep an eye out for the next video. I'm going to probably try to drop that next week. Episode 2 will be about fair value gaps and imbalances, where I'll really just dive deeper into the concept of fair value gaps and just really break those down for you guys. And I love to make these lessons because I get a lot of questions that people ask me about these concepts and about these things, and it also just helps me learn them and practice more. So it's really helpful for me and for you guys. Obviously, I really hope you guys are able to take something away from these videos, because I do spend a lot of time making them, and although it's fun, it is very time consuming and it is pretty hard. So I really hope you guys appreciate these. Let me know if you guys want any specific topics, or if you guys have any questions. I'll always try to answer them, or at least make a video on things. And like I said, just keep an eye out for the next videos. I'll be getting back into the swing of things and making more videos as well throughout the next few weeks, and throughout the course of just price action over the next couple days. So keep that in mind, and drop a thumbs up on the video, like it, subscribe if you haven't already, comment, share with your friends, all that fun stuff. And I appreciate you.